Sometimes doing the right thing will cost you millions of dollars, and you know what? If you're not willing to pay it, your community will. Last year, I watched somebody take the bait. More money, more commissions, and you know what? It didn't affect them at all. You know who it hurt? The people that trusted him. Look, I ran the numbers, and choosing to do what was right versus what made me more money has cost my company over $11 million. $11 million. So you're probably thinking, why would anyone be willing to walk away from that kind of money? Well, it's what the wealthiest families throughout history, the Rothschilds, the Rockefellers, the Morgans, the Stanleys, they've all done that, so should I. Because most people don't understand that once you stop giving and you focus on getting, everything flips. Oh, damn. In this episode, I'm gonna show you exactly how banks really make money. And I'm gonna show you why most financial gurus sell what pays them the most, and how you can take back control of your money by learning how to think like the bank. So if you care about your money, your family, and your legacy, do not skip this episode. Come on. Recently, I had one of our what we would call affiliate partners make a really poor decision. And I got to just kind of call it out. I'm not going to give any names here, but that decision was to take the bait. You know, in life, you're going to be challenged. You're going to be tested over and over and over again. And sometimes you got to do what's right, not for you, not for your pocket, not for your bank, but what's right for everybody else. Let's just talk about somebody's community. We have a big community that we serve, and I always like to think I'm doing what's right for the community. And what's right for the community, let me just tell you what that's cost me. I ran the math, and this is just an estimate, but probably pretty close. It has cost us roughly $11,130,000. So how did I come up with that number? Well, we're going to get into that in just a second, but remember, over $11 million I have had to give in order to get. So this person that I'm referring to definitely didn't go that route because they were not willing to give in order to get. They wanted to get, and they made a decision that will, at the end of the day, come back and bite who? Maybe not them, but their community. Their community will pay the price. And if the community was my community, it would have been a cost of roughly $11 million and then some. So let's get into that. One of the things we teach people is we teach them how to take back control of their money. This stuff. So any of you listening, I'm just holding up a bunch of money here. And this money was worked for, right? All of us have learned how to go out there and how to earn a living, how to earn money, the almighty buck if you live in the United States of America. But all we have learned to do is to make this. We haven't learned how to make this work for us. And let me prove that, because what is it that we've been taught to do with all the money we make? We've been taught to take the money and immediately deposit it in someone else's bank. Now, I know that's just the norm and nobody sees a problem with that. And heck, I do the same thing. This is why I know this to be true. We put the money in the bank. Now, let me ask you something. What does the bank give you? What does the banks give to you? Well, it's interest, right? How much interest are you earning on the money you leave in the bank? Is it 0, 1, 2, 3, 4? Or anyone getting 5 anymore? Even if you were, it's probably declining very quickly. So that's the give for the bank. They pay you interest on the money you leave in their bank. Now, what do? What does their get? Well, they get control of your money. They take your money and they lend your money out. You see this happen every day. Heck, you're part of this. And do they lend the money out at a higher or lower interest rate than what they pay you? So let's just hypothetically assume you found a bank that pays you 3% interest on the money you leave there. You're making 3. That was the bank's give to you. Now you go back to that bank to borrow money for a car. Let's just pick a car loan. And the bank gives you an interest rate of what? More than 3, right? Of course, more than 3. It's probably right now about the average, which is about 8%. Some of you could find them for 6 or 7, but all the numbers you could find out there, even the lowest interest rate you could get on a car loan would be more than what they pay you in interest. And that's because the bank has learned how to give and get. The bank paid you 3, they get a much higher interest rate. No matter what kind of loan they do, they're going to make more than what they pay in interest. And that means they make the spread. All I teach people to do is to take back control of that. That's right. The banking functions in your life. I just explained the banking functions you're giving away. Now let's talk about how do you take that back? Well, first, you must find a better place to deposit your money. So you deposit your money in a better place, a place that will pay you higher interest, maybe better tax advantages. A lot of things have to be better than what the traditional bank is giving you now. Now, you might not get the dumb sucker, but nonetheless, you're going to change one thing, and that is where your savings goes first. We're going to deposit your savings in a different institution, an institution with different principles, an institution with different motives, and an institution with different gives than the traditional bank. That institution is one of the strongest, most solid, most financially secure institutions in the financial world, period. And it isn't just now. It's been that way for hundreds of years. And don't take my word for it. You could go back and follow the Rockefellers, the Rothschilds, the Morgans, the Stanleys. You could follow all of them to find out that they did the same thing I'm about to tell you. And that is changing one thing, where your money goes first. And that institution that the wealthy have used for seriously centuries now is none other than life insurance companies, but not just any life insurance company. I'm talking about mutually owned life insurance companies. And how are we going to deposit money in the insurance company? Because you can't just walk into an insurance company, a mutually owned insurance company, and say, hey, I'm here to make a deposit. Where's the tellers? Where's the deposit line? They would say, sir, it's out the door, down the street. There's a traditional bank right there on the corner. Matter of fact, there's a traditional bank on every single corner of this city, town, or area that you live in, because that's what banks do. I'm talking about insurance companies. They do not operate the same way. So therefore, you can't just make deposits and into an insurance company, because they are not a depository institution. They are a life insurance institution, a life insurance company that is in business to make promises for long periods of time into the future. 5, 10, 50, 100 years into the future is the promise they're making. And they're making that promise that they will pay the benefits on the contracts that are issued today. So what did the wealthy find out? And what do you do? Well, you're going to take your savings and you're going to change where it goes. You're going to put it into, pay attention. The first couple words are the most important: specially designed. Let me repeat that again. You're going to deposit your savings into a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends, because this is how you become the bank and take back control of your money. Now, let me explain why, because what I said there makes no sense. But all I wanted you to pay attention to is specially designed, specially designed, specially designed. These are not normal life insurance contracts. They are designed and engineered to do what we're going to talk about. Because when we make a deposit into the specially designed policy, that policy has immediate liquidity of up to 60 to 90% of your money. I said that right. 60 to 90% of your deposits in a specially designed and engineered whole life policy can be used in the first 30 days when your check clears. So once your check clears, we've got liquidity. It's not 100%, but that's okay, because I don't know many people that deposit their money in their bank, the savings, that is, deposit their savings in a bank and take all of it back out immediately. Okay, so that doesn't typically happen. Now, the reason that there is a discrepancy, the reason that you don't have access to 100% of your money is worth talking about. It's costs. None other than cost. Number one, you got commissions. Okay. Number two, you got a policy service fee, usually $50 to $100 a year. And number three, you have a cost of the life insurance the insurance company is providing you. So those are your three costs inside of a specially designed whole life. And those costs are the reason why in the first couple of years, what you deposit is not what you can take out. However, they have some unique benefits that make them optimal for banking. And remember, how did banking work? You made a deposit into their bank, but then their bank controlled your money and lent it out at a higher rate, making a spread. So let's talk about that. How would your policy serve as a function just like the traditional bank? Well, the downside is you're depositing your own money, but that's okay because you're creating your own private banking system. So you deposit your money in there, your savings. Now, let's just say you want to buy a car. If you were going to buy a car using your bank instead of their bank, you first must capitalize your bank to the tune of the amount of money that you want to spend on a car. So if you wanted to buy a $25,000 automobile, you must have at least $25,000 or more in your cash value policy in order to buy the car. I mean, you can't just go and take money from nowhere. You got to save it up. You would have to do the same thing in their bank, but the whole while you were saving in their bank, they'd be using your money to lend out and make that spread. So here's what we're going to do. Once we've capitalized our bank, the policy, we're going to find a car that we want. But when we buy the car, we're not going to use their financing. We're not going to use their banks. We're going to use ours. We're going to take a loan from our policy and we're going to pay for the car. Now we own the car, but we're going to follow the same rules a bank would follow if they were making a loan to you for the car. And what would those rules be? Number one, the bank would ask for an interest rate. So let's just say you found the cheapest interest rate at 6%. Okay, that's how much. Well, let's make it 7, because right now I doubt you could find a car loan for 6. Let's say it's 7%. So you found yourself a bank loan at 7%. So what you do is you take a loan from your policy and you buy the car, but you pay yourself back at the same interest rate you would have paid their bank, 7% in this example. So now let's just do the math. First off, when you put your deposit into the life insurance company, into that specially designed whole life contract.
Hey, you need to become your own bank. And it's as simple as changing one thing, and that is where your money goes first. I mean, think about it. Household debts in this country are at all-time highs. Here's the good news. Every single Wednesday at 1 p.m. Eastern Standard Time, I put on a free webinar where I teach you how to take back control of your money by teaching you how to become your own bank. That is exactly how you're going to turn the tides. That is how you're going to mimic what the wealthy do. So it is time to become your own bank. So click the link below and let's get started.
But let's get back to the car. You're going to pay yourself back the same interest rate and the same payment you would have paid their bank. That doesn't make sense, right? You're all probably thinking, wait a second, Chris. If I saved up enough cash to pay for the car, why wouldn't I just pay cash for the car? Well, we'll get to that, because if you owned a bank, you would never steal from your bank. And if that's the way you did it, you would be stealing from your bank. So remember, we put our money in that specially designed whole life. Now, how much do I earn on my money in that whole life? Some of you are asking, because I got a traditional bank that'll pay me 3. How much is the insurance company going to pay me? Well, right now, the lowest interest, it's called dividend crediting rate, which includes the guaranteed interest rate and the dividend. The lowest company that we work with right now is 5.75%. That's what they're paying. That's their gross dividend crediting rate. Now, is that better than what you're earning in the bank? The 3? Well, yes, it is. But also, because we designed these policies right within the IRS rules, that 5.75% or whatever interest rate and dividend you get with the insurance company, it's tax-free. It grows tax-free. So as you're earning interest, compounding that interest over time, it's all going to grow tax-free. Your bank account doesn't work that way. You're taxed every single year on the bank account. So we're already putting our money in a better place than a bank, but you're still caught up on, I can't use all of my money, so the bank is still better than that. Yes, because you got a death benefit that's attached to that policy, and that death benefit has a cost, and we have a commission that we get paid. But let me hit those 2 things. Number one, there's not a single person listening to this podcast that right now does not need or will not need life insurance into the future. I have a little one. I have a 4-year-old. She's actually 4.5 now. There's not a day that goes by that I don't want to leave her in a better place than I was. Okay. If I'm gone tomorrow, there's not a single day that I don't think about leaving her in a better place. Now, my structure is different than yours. My goals for what I want to leave are different than yours. So we're not going to get into the trust and all that stuff today, but you certainly have somebody that you care about that you want to leave in a better place when you are gone, right? Well, there's a cost to that. And that cost shows up in those first couple of years because the amount you deposit is not the amount you can take from the policy. That is the give. That's your give. Okay. But you also get, but you don't really get, your family gets if you die. So that's the give get. Okay. But now hear me out. Remember, you're earning, let's just call it 5 to 6.4%. That would be the range right now, dividend crediting rate. It's growing tax-free. It's protected against judgments and liens, and you have a death benefit. Now, let's go to that bank account you had. 3%, okay, is what you were getting on that. You're taxed on that compounding interest every single year in the form of a 1099. Not only that, that money is not protected against judgments and liens, nor is it protected against probate like the policy is. And do you get a death benefit with your savings account? Nope. Do you get it with your checking account? Nope. So I'm trying to identify and show you that we are in a better place with our money. It is protected and you control it. Because now let's go back to the car. We take the loan from the policy, we buy the car, call it 25 grand. The finance company or the car dealership would have charged us 7%. So we are going to make payments every single month in the tune of 7% back to our bank, which our bank is that policy. We're going to make loan repayments to the bank. Now, let me talk about when we took the $25,000 out from the policy. We didn't take our money. All of your money, all $25,000+ in cash value is in your policy, earning that guaranteed interest rate plus dividends on an uninterrupted compounding basis. Your money's still there. It's safe. It's earning all of it. You could never do that with a bank account. So whose money did we use? Well, of course, we used the insurance company's money. They loaned us the $25,000 from their general account. They used our money in the cash value to collateralize the loan. And then they don't even care if you pay the loan back because they're just going to subtract it from the death benefit should you pass away too early. So the insurance company's fully protected. They're collateralized. And if you die, there's life insurance that pays them off. Got it? That's it. But it allows your money to earn at an uninterrupted compounding basis. So now let's talk about spread number one. If you were making 5.75 and the insurance company charged you 5, how much would you be making? 0.75. If you were earning 6 and the insurance company charged you 5, how much would you be making? That'd be 1. That's gross and that's hypothetical, and not every policy is going to work that way. But I'm just trying to get you to think like a bank, because that's how a bank thinks. A bank thinks the cost of capital, which is the interest they pay you, that's what our cost is. So if we're going to lend money out, we have to lend it out at a higher rate than what our cost is. So if they charge you 3 and they lend it to you at 7, they're making a spread. Same thing, but we're going to hit 2 spreads here. So if the insurance company pays you more than what they charge you to use your money, that's good. Now, you're going to pay yourself back, pay your bank back the same amount the bank would have charged you. We identified that as 7%. Is 7 more than what the insurance company charged to lend you the money? Yeah, remember they charged around 5. And the insurance companies we use are either a little under 4 to as much as 7. So that's the spread. So you'd have to make sure that you got the right insurance company for this particular need. So I'm using an insurance company with a 5% loan interest rate. And if you were paying yourself back at a rate of 7, how much are you making? 7, the amount you're recapturing and repaying yourself, minus the 5, the cost of capital, is spread number 2. You're making 2. So 2 plus the hypothetical 1.75 I gave in the beginning would mean, well, all it means is you're doing better. Plus, every payment you make on that car that you're putting back into the policy is money you have to use the next day. You lose no liquidity. When you make a car payment to a finance company, you can't get that payment back. It's gone forever. So if you did just that circle, start with your money in the policy, the specially designed whole life policy, not an IUL. We're going to cover that in a second. IULs do not work. Okay. And then you buy the car and you pay your policy back, your bank back, the same amount you would have paid their bank. You now just created a circle, an infinite circle, because that's called the infinite banking concepts. I just showed you how to make all the money back on every single car you ever buy, drive, and own, and you don't have to sell the car. You just learned something because you learned how to become your own bank. Now, let's get back to a couple things. Specially designed and engineered whole life. When we design these whole lives, it forces us, the agent, the general agency, which is what we are, to take a reduction in our commission because we reduce the death benefit down to the very lowest level of death benefit that we can put on the policy. The lowest level is determined by the IRS's MEC 7 pay rule. So when we lower the commission, we also lower when we lower the death benefit, we also lower our commission. The two are tied because that's what we get paid on. We get paid on the cost of insurance, the death benefit, and the cost for that death benefit. That's how we get paid a commission. So what do we have to do? We have to reduce our commission by 60 to 90% on every policy we do. So let me just give you those numbers again. Remember, now to design and engineer these policies to work for the infinite banking concept, we have to set them up so that we get paid significantly less, 60 to 90% less. So what I did is I just went into 2024's numbers. I figured out that roughly by the end of the year, we should be at about $30 million in premium deposits that our clients are putting into these specially designed whole lives. Now, if we did this with normal whole life, if we didn't design and engineer them, that would be roughly a 55% commission on that $30 million. Yeah, we'd be making $16,500,000. Woohoo! But we didn't. You see, most of our policy designs average out to be about 30% of what we put into the policy's base. 70% goes into the paid up addition. So I just did the math. Now we're paid significantly less. Like how much less? Like 53% less on the paid up additions. So we get paid about 2% on paid up additions, give or take, and we get paid about 55% here in New York on the base. So remember, I said 30 million at 55% would assume we put 100% into the base, but that would just be a normal whole life. That is not what we do. We put a lot less, roughly 70% less of your premium deposits go into the base. So we're taking a 70% reduction in commissions, but then we're putting that 70% into paid up additions. Yes, we're getting paid too. So I did all the math. What that would mean is we get paid on roughly 30% of all the policies that we do. Okay, 30% of all the premium deposits that we put into all the policies that we do. So if I figured that out at 55%, so that would be $9 million of the 30 million is what we receive a commission on. That would be $4.95 million. Now, 70% of that money, or $21 million of that $30 million, is going into the paid up additions, of which we get paid roughly, give or take, about 2%. So that's 420,000. So if I had the 4.95 plus the 420, that means we would make $5.37 million. Now, I'm not saying that's bad, but it's not $16.5 million. That means that we had to give up $11,130,000 in potential commissions to design policies that work for you so that you have access to 60 to 90% more cash value. In most cases, it's actually 100% more cash value in the early years than you would if you did a regular whole life. So what am I getting to? Well, first I wanted to teach you something to make this worthwhile, but now I want to go back to the give and the get. We had to give so that our clients get. We had to give so that you potentially will get more cash value immediately in your policy and more cash value forever in your policy, because remember, it's just compounding. So what did this affiliate do? Well, this affiliate was doing quite well. We were doing a lot of webinars for them. We were doing lots of videos for them, and we were servicing their clients and in which they were getting paid, and they were getting paid quite well. But quite well to us means that they were getting paid 60 to 90% less commissions because that's how we design the policies. So another guru got in their ears who sells IULs. And the guru who got in their ears who sells IUL said that the policies we do are no good and the policies they do are the best, blah, blah, blah. I could unravel that, but I've got so many IUL videos out there, and I'll do another podcast to talk about the difference between whole life and IUL. If you love podcasts, there's a huge difference. IULs cannot, let me repeat that, cannot and will not work for the infinite banking concepts I explained earlier. And there's a lot of reasons like surrender charges and cost of insurance increases and all sorts of differences in those policies that are not suitable for, and I said a key compliance word, suitable for the infinite banking concept. But this guru came into the affiliate that was working with us and told them that the policies we do aren't as good as the ones they do. And not only that, I'd have to believe, this is just speculation and just my opinion, I'd have to believe they explained how much more in commissions this affiliate would earn if they used IULs. if they use this guru. And they are absolutely correct. Because remember I said, if that guru did 30 million in premiums and they got paid 55% on New York policies, I'm just referring to New York policies to keep this all the same, they would make $16.5 million. But you see, IULs pay even more than that. IULs can pay way more than that. But let's just assume that all things were equal, that's what the IUL paid. Would the affiliate want to make an additional percentage on $11 million? Or would they want to take that reduction of a percentage of that 11 million? You already know the answer. Of course they want a percentage of 11 million. And of course they don't want to partake in the difference of not earning a percentage of that $11 million in this example. So in other words, the guru said, you will make significantly more money if we sell IULs to your community. To which that guru is 100% right. However, although the affiliate and this guru are going to make a whole bunch of money, the clients, this affiliate's community, are going to stand to bear the weight of that, because somebody's got to give and somebody's going to get. What are they giving up? They're not. They're just getting. You see, it's a change in philosophy, a change in ethics, a change in the way you think. We always will remain true to giving up commissions so that our clients have 60 to 90% more cash value to use immediately, versus the IUL folks who that is not the case, never has been the case. They just make more money, and I can prove it so many ways. But I had one come up to me out in Orlando at an event I spoke at, and he said, hey, if you just use our software and you do this, we could make so much more money. And you're right, because IULs can pay up to 120% of the premiums. Of course, I'd make more money. But at whose expense? That's the question. I could make a lot more money. This affiliate will make a lot more money. But the real question is, at whose expense? And the only answer is at the expense of the client, at the expense of the affiliate's community. And that, to me, is always the wrong choice. I will always remain true to giving first. And I will give commissions as much as I have to so that my clients' problems get solved. Others, this guru, the affiliate, well, they can take the bait and they'll make a lot more money. But you know what? Making money is a funny thing. And the universe is a funny thing, because when you stop giving as your primary and you start just greed, it's called, when you start focusing on getting, how do I make more? Everything flips. I just don't know how long it takes, but it happens every single time. And it will happen to them. Folks, all I can tell you is it's always best to give first, and don't focus on the get, because the universe will always give back to the givers, but not if you focus on the get first. Thanks for joining me for this episode of the Money School Podcast. We will see you on the next one.